Well, good morning, everyone, and thank you for joining us for the quarterly update. We've been doing this for a couple of years now. I've recorded this session 24 hours in advance because of travel and vacation. So if something major has happened between yesterday and today, then that's not included in this in this session. So what we want to do today is we call this sort of the apartment dangers, opportunities, and strengths that are going on. There's a lot of transition going on. We've got talk about the old Western movie with Clint Eastwood, the good, the bad, and the ugly. Okay, so let's get started. So the first thing that I just want to say that we have Rod and I have written this book, and it's called The Self-Funding House. It doesn't have a whole lot to do with rental apartments, but it sort of does. It's all about how do young people buy a house. Well, they can buy a house today by becoming landlords themselves, by duplexing those, putting in a backyard apartment, an accessory dwelling unit, and so on. So we wrote this book called The Self-Funding House, Rebuilding the Dream of Home Ownership. And it got published on March 15th. And on March 15th, it was the 94th best-selling book in the world. Now, I don't know if that's good or bad, but it was the 94th best-selling book in the world on that particular day. And if you have an interest in and it's mainly written for younger people and their parents, of helping your children buy a house or how young people buy a house. This is the mind shift that I think people need to go through in today's world. For many of us baby boomers, when we bought our first house, it was 3 times our income. Today, it's 15 times our income. And that's a very different and difficult dynamic for younger people today. But this book is about that and how you go about solving that problem. And really the message from the book is, the best way to own a home is to become a landlord. And then as you become a landlord, your first house becomes your first business, because now you're running a small business, going to teach you skills for the rest of your life. So if you're interested in that, it's available on Amazon. So for today, our topics are going to be, about the good, the bad, and the ugly. And there's some of it everywhere. So for sure there's good news in the apartment sector, and it's pretty powerful, positive news about apartments. There's not so good news out there, and you're all aware of those. We'll go through that quickly. But more importantly, given the time that we're in, I think there's some very interesting strategies that apartment owners can think about right now in terms of acquisition, disposition, exchanging, and things along that way, and also expanding your opportunities for acquisition into the United States as well. We're going to talk about that today. Okay. So, we're in a cyclical business, right? Real estate is cyclical, and we're going through a cycle right now. And, we've been through the part of, I think, overconfidence, okay, where everything was going really, really well. There was excitement and there was overconfidence. And now we're heading into, we're going to show you here the red part of this. We're probably in this part of the market right now, right? Into denial, regret, maybe there's a little bit of fear, and who knows where the bottom is, but I think that the greatest opportunity to buy is at the bottom of the market, and maybe a bottom is forming. But I liken this to, for many years, people with cash sat on the sidelines getting, a 0.25% per year return from bonds, and now today bonds are 3, 4, 5%. And we're kind of going, well, I just missed the top of the market. I could have got 4.25, and now I got 4.15 or something like that. But relative to what was available before, a 0.25 point, for that same time period, they are very, very good returns. So I guess what I'm saying is, when it comes to, buying GICs and buying treasury bills, how are you going to catch the exact top of the market, right? When we've been at a 0.25 point and now we're at 4 points, right? So let's start thinking about what would be a good time to make an acquisition. Nobody wants to catch a falling knife, but I think that the bottom is starting to come in, and you're never going to know when the bottom is there. But maybe one of your criteria is do I hit my yield expectations? Do I hit my hurdles on investments today? And we're going to talk about that. So we think we're in this cycle of the market now, heading down, and maybe we're there already, where panic and despair sort of come in. But I do think about the bond market and saying, you get to catch the bottom of the market. No, you don't. The point is, you just need to catch sort of, the bottom of that cycle of a successful real estate investment. So let's start with what's the good news. And in the apartment industry, we probably have better news than most people. And the good news is is that rent is strong, right? Apartment demand is extraordinarily strong. So in most Canadian cities, vacancies are at the lowest rate they've been, and rent increases that people have been getting have been very, very significant. And it doesn't look like that's going to end, with a lot of condo projects being paused, a lot of rental projects being paused. And paused is the word, I wouldn't say canceled, because we're still in the fog. But demand for rental apartments is going up. And it's not just immigration, right? It's the barrier to entry for home ownership is higher. And those high quality homeowners who are priced out of the market are now renters, right? So they're forming the top end of the market because they have money, just not enough to get in the home market, or they don't want to get in the home market at this stage. So rents are up, and demand is up. And the greatest enemy of apartments is not a recession, okay? It's overbuilding. And we are nowhere near overbuilding, really, I think, in any Canadian market. So even if we have a recession, we're in one, or we're heading into one, or we're heading into a severe one, who knows? Point is that apartments generally do very, very well during those times. And the danger to apartments is overbuilding. And I don't think there's any Canadian market that's overbuilt, or any Canadian market that's close to being overbuilt. So apartments are the darling of the apartment industry, of the real estate industry. I think they've surpassed industrial. Remember, there's always CMHC financing, which is always there. And so I think that is the good news, that foundationally, no matter what happens, apartments stay pretty full, rents stay pretty high. They don't drop off really much in a recession at all, if at all. And right now, rents are going up because of all the other things going on in the marketplace. So there's a lot of good news in the apartment business on the revenue side of things and on the demand side of things, right? So this shouldn't be a surprise to people. This next chart I'm going to show on apartment transactions, you can see that we plotted here for the, since January 2021 to 22 to 23, the number of apartment transactions that have occurred across Canada. And it varies. I don't think it's a seasonal business, but you can clearly see a trend in the last 12 months as to what's happened. And if you look at the chart, you'll see in January and February of 22, there were 67 transactions and 66 transactions in 2022. Now let's fast forward to January and February of 2023. You can see that number has dropped down to a paltry 10 and 12 transactions. So that's a significant reduction in transactions. And I think that, that is the challenge here has been interest rates, and interest rates have gone up during that period. And interest rates and cap rates have a relationship, which I want to talk about. But the message here is that from going from a robust market of, let's say 50 to near 100 transactions every month, it's dropped down to 10 or 12. And I don't know if that's going to change significantly, because there's a spread between the bid and the ask. There probably will be more transactions as sellers realize and have to realize that the marketplace has changed, but it hasn't changed that much. We're still going through what I would call discovery pricing. So this is really a really good chart. And if you've been with us on other webinars, you've seen this before, but it just continues to, I think, enlighten the situation as to what we're facing right now. So I'm going to explain this fairly quickly, and this is showing trends since 2000 till today, and then projecting trends a little bit. So the yellow line is the buyer IRR target, right? And so that's the kind of return that a buyer is going to expect to have. And you can see that buyer IRR target started there at about 11, and now it's down to about 6, right? And so buyers are accepting lower returns for apartments because of the stability of apartments, the financing that's available, and just the overall investor demand has turned to apartments, right? So the second line, the green line, is apartment cap rates. Now, keep in mind, this is US data. The one thing about the US that's really good about it to invest in is that it's a very transparent market. There's a lot of data there. And unlike in Canada, where it's not a very transparent market, there's not very many transactions. We had 10 transactions occurring, in January, February of this year. In the US, there are hundreds of transactions, and they're just reporting systems that creates transparency, and then transparency creates a market, right? So the green line is cap rates. And you'll see that cap rates and buyer IRR targets essentially follow each other, right? They're two sides of the same coin. And so you can see that cap rates have been coming down traditionally following the yellow line of buyer. Now, the interesting line is the blue line, and that's 10-year US Treasury rates, and that's interest rates. So everyone says that, cap rates should go up because interest rates are going up. Well, the data doesn't really show that, right? Because interest rates are temporary. Cap rates are permanent. You buy a building at a cap rate of 4%, you bought it forever at that price. Yet your mortgage, whatever mortgage you inherit or whatever mortgage you get, will certainly change in the remaining time of the mortgage you inherit, or within 5 years or 10 years, the term that you take. And so look at the relationship between the green line and the blue line. And if conventional wisdom says, or buyers will say that interest rates have gone up, therefore cap rate should go up, well, I would show them this chart and say that's actually not the case, because you can see that the blue line and the green line do not track each other at all. Sometimes the spread between the green line and the blue line is very small, and sometimes it's very large. And that spread between the green line and the blue line is represented in the gray bar chart below, right? You just point to that. So that's the spread between the cap rate and the 10-year US Treasury. Now, if you look at it, there are times where the bar chart's quite high, so there's a big spread, and that's probably a really good time to buy, right? There's a big gap between the cost of money and the cap rate, and so that means there's a spread there, and you would expect probably cap rates to maybe compress during that period. But look at around in 2006, you can see where the spread is very low, right? But between the green line and the blue line, between interest rates and cap rates, there have been times before it's been like that. And now let's go to 2022, 2023. This chart done by this really smart economist in the US, Ron Witten, sort of predicts that, and everyone's making predictions, but if anyone's going to make a prediction, this guy's qualified to make one. We expect cap rates to go up, and they probably have gone up 50, 75 points. It's hard to say because there aren't that many transactions. And when you look at a transaction, you have to look at what's behind the transaction. What was the mortgage in place already? Was there a vendor take-back mortgage at preferential rates that resulted in that cap rate being what it was? But the thing that I want to point out here is that the spread between interest rates today and cap rates is probably the lowest that it's ever been. And that's the reason that you're seeing the reduction in transactions. There's a big disconnect between the buyer and the seller in terms of what pricing is. And when that occurs, then that spread is almost like the inverse of the number of transactions, right? So the tighter that spread, or the lower that gray bar is, the lower the number of transactions that they're going to be. And then as interest rates go down or cap rates go up and that spread increases, we'll probably see transactions occur again. So let's go on talk about sort of the bad, right? So there's lots of things that are, the good is that rents are strong and occupancies are strong. So your top line should grow pretty well, but you've got significant pressure on your operating costs and your financing. So operating costs are going up, interest rates are going up. We're probably going to see municipal taxes go up, insurance has gone up, and things like that. Now, I think that most of those, if you're in a building where you can, charge market rents on the majority of your units, then those rent increases are offsetting those costs, and probably your NOI is growing. If you're in a marketplace like Ontario, where you need vacancy, people need to move out to raise the rents, then you're probably going to see some erosion of your NOI because your rents are capped at 2.5%, but your operating costs are growing much more. So what's happened is, and I think everybody knows this intuitively, but vacancy or turnovers is going down, and turnovers are going down dramatically because tenants who are in called legacy apartments, chronically depressed rent apartments, are not moving. And because they're not moving, landlords can only raise their rent, the guidelines. So 2 years ago, 3 years ago, there was higher turnover in buildings. Let's say that turnover was, 10, 15, 20%. So on 10 or 15 or 20%, you could go in, do some renovation work, fix up the unit, and raise the rent. Today, that number has dropped in half or by 2/3. So there isn't that much turnover, so there's not the opportunity to go in and invest back in the building and then charge market rates. So what was working 2 or 3 years ago doesn't seem to be working today in terms of older buildings. And it's sort of the challenge again that investors are having in a turbulent market is, how do you catch the bottom of the market? Because to some investors are telling, they feel like, look, we don't know if the bottom is in, but we're not going to be able to find something. We're not out there looking, putting in offers, understanding the market, and so on. So I get nobody wants to catch a falling knife, right? But there are going to be better deals available. Transaction volume is lower. Many of the buyers aren't in the marketplace. Some people will need to sell, and there will be creative deals, and we'll talk about that in a minute, right? So what pension funds are telling us for the last year has been, look, we can't hit our yield targets, okay? And we said, well, what's your yield target? And then I go back to the seller and say, what can we do to have the buyer hit his yield target? And that might be in the form of a vendor take back mortgage at a below interest rate, and then we can sell that mortgage, or they can keep that mortgage, you know, depending on what they want to do. But I think it's for some buyers, not everybody, not the institutions, but I think for the private money, people are starting to say to us, it's time to start looking and time to put in offers. And we haven't been saying this for the last year. We do this quarterly, but we're getting that feeling that we're seeing transactions occur, but the numbers still are very low, right? 10 from 60 is a dramatic drop, but I think sentiment maybe just saying we don't know the bottom is in. We go back to that cycle chart, but we're never catching the bottom of the market, so we need to be looking because maybe the bottom is coming in. And I think that we're now presenting more sellers' offers. So after we counsel the seller and we understand what they want clearly and what they don't want, what they can do, what they can't do, what they can add to the deal, and we talk to the buyers and we've counseled them. We know what they'll do, what they won't do, what hurdle rates they need to. People still aren't necessarily in the groove of putting in offers, right? So we'll say to the seller, let's do a seller's offer to the buyer. What are you willing to make the deal work? The buyers told us what they need done. We'll go find them the deal and have the seller sign an offer and give it to them saying, look, here's what we're prepared to do to make the deal work. And we just quite frankly haven't had to do that before because the market was so strong. If we got a listing, we would get 20, 30 CA signed, we'd get, tours, and we would get 10 or 12 offers, right, on a property. And so the seller sort of just waited back and said, bring me the 12 offers, we'll do a competitive bidding process, and the best buyer will win. But today you don't have that 10 or 12 buyers there typically for a project. There's some, but finding the right buyer and then creating the deal that works for him that also works for the seller is probably a strategy that is certainly something we're doing right now to go forward, right? So, there's a lack of information in the Canadian marketplace. I couldn't draw that chart that I showed you from US data because the information isn't available, there's not enough of it, and we can't make those conclusions. But I think that, the lack of information in a marketplace is an advantage if you have the information. So we track things, in our company, probably closer than most, who the buyer is, who the seller is, what the transaction is, what went on behind the transaction that actually gives you an indication as to where the market is, because the price per unit or the cap rate certainly tells you some things, but you need to know what the existing financing was on the property because that is a factor of the cap rate. So we spend our time staying in traffic. We're saying that you should spend your time staying in traffic because we're coming to the part of the cycle where it becomes very opportunistic for private buyers. And for private people, they have been sitting on the sidelines for a good decade, right? Keeping their powder dry. Well, this might be the time to start looking in the marketplace. And we have some ideas on that. So stay in traffic. Buy-side brokerage is probably about 25% of all the deals we do, and we've been more active in buy-side brokerage because, if we get a buyer who knows exactly what they want, we can go out in the marketplace and find them that product. And we're going to expand that network and that geographical footprint now to the United States. So You know, what municipalities have the lowest taxes? Where are the rents the lowest? Where's their chronic demand? There's chronic demand everywhere, really, but where is it really opportunistic for you to start buying? Um, we started talking to institutional buyers. They have hurdle rates, and they can't hit that hurdle rate right now based on common metrics. So we're saying, okay, what can you as a seller do to help that institution hit their hurdle rate? Not forever, but for the next 3 years or 5 years and things like that, right? So when interest rates are higher, what can we do to make the deal better? What can you add to a deal to make it better? And I'll talk about that in a moment, right? So, you know, how do you get access to deal flow and to quickly identify the opportunity? Well, the first thing is when you're doing a deal in a difficult time, and let's say there's a buyer, a seller, and there's a cooperating broker, right? I think you need to be transparent, right? In a really strong market, you know, you can bluff, you can do the things that you do in a strong market. But I think here it's, you know, the seller has to tell us what they can do, the buyer has to tell us what they can do. And if we can get creative and put those two together, then a deal can happen for both people's benefit. You know, think about how you buy a new car. So you take your old car to the dealer and it's worth $20,000. And then you say, I'm going to add $30,000 worth of cash, and you're going to drive off the lot with a $30,000 or $50,000, let's say, brand new vehicle, right? So I took something there that was worth $20,000. I added $30,000 to it, and then I got a car. Okay. Well, why can't I do that with a real estate deal, right? I've got a $2 million piece of land. It's non-saleable. I got to sell it. What if I added $2 million of cash to it? Now someone trade me or exchange for me a $4 million piece of something, piece of real estate, small apartment building, a second mortgage that you're holding for that, and let's, you know, and let's make a deal, because I want to sell my land. I want to sell it badly. I'm a don't want it for the land. I've got $2 million in cash I'm going to add to it, but I don't mind taking back something worth $4 million to facilitate that exchange. So nobody thinks about adding cash to make a deal work. But yet when you have a car, you always think about adding cash to make a deal work, right? And then you think the next leg from the car dealer, he now takes that car, refurbishes it, and sells it off to Russia, or puts it on his used car lot, or sells it to a wholesaler, who then, you know, puts it back out in the marketplace again, right? So I think a lot of interesting things are going to start happening to get the deal across the goal line with, you know, second mortgages, buying and trading, you know, paper, and so on. And we're spending, but there's no one formula here, right? It really is spending time with our clients, with both buyers and sellers, to understand what they're willing to do to make a deal work. Okay, so the next slide. So the people are in a high cash position today, private people, right? So how do you get access to deal flow when you're in a high cash position? Well, you know, we're used to listing buildings, right? I'm almost saying now, let's list money. Okay, so you've got $10 million that you would like to invest. You give us your geographic footprint, your requirements, your return, your feeling about what you want to do with that money. And you've been sitting on that money for a long time. You believe that maybe we're coming to the part of the cycle where there's opportunistic buying. Let us take that money that's sitting on the sideline, okay, and without any risk, let's go shopping with it, right? Let's narrow your focus down to something that geographically makes sense to you, economically makes sense to you, and fits what you've historically invested in, understand, or where you want to go. So I think there are many people in a high cash position today, and there's lots of opportunities coming up, and we think of the money as the listing. So we say we've got $10 million, we're looking for this. We go out to the marketplace and try and find that. Then we bring you that deal to look at. You do your normal due diligence, and, you know, and so on, and that will lead to deals happening. We recorded a session on Tuesday, March 28th. And really, it was time. We're going to do this again because they had a terrific response to it. How Canadians invest in U.S. real estate. So Rod is going to send you, Dave Price, actually, sorry, Dave Price will send you after this session an email that includes the first recorded session we did on March 28th. Okay, and we're also going to send you a gift, a book that we've written with the two participants in that seminar we did March 28th. on joint ventures, right? How do you structure a joint venture? Because you can make developer returns in both Canada and the US on that. And then we've got another session coming. So if you're interested in investing in the US, watch that recording we're going to send you on March 28th. And then we've got our second session coming up on April 24th. These are 90-minute sessions. There's no charge for them. And we're actually going to show you transactions that we've done using this strategy of buy-side brokerage and Canadians going to the US. And then we're going to show you deals that are for sale right now, okay, that you can invest in. And then we're going to go through some specific, we're going to dissect a few deals and show you how they occurred and the creativity that we use to make them happen. So we've created a logical process to take money sitting on the sidelines saying we want to invest it. And Canada's a very small market. I mean, we're 2% of the world's commercial real estate. America's 25% of the world's commercial real estate. But in the US, it's not 10 times different. I think it's 100 times difference because there's just different rules, different types of money there. 1031 exchanges, we'll explain that next week. It just creates much more deal flow and much more opportunity in the US. So what we want to do in these separate seminars, the recorded one that coming up on April 24th, is to give you guidance on how to approach opportunities in the US. And then after you got a sense as to what we're doing and how we're doing it, Dave Price will be chatting with you about exactly what you want to do, what you don't want to do, what you have to invest in, and what you're willing to do to make a deal work. Fascinating process. And we think about it sometimes as the exchanging of real estate, the way you exchange your car with cash to get a new car, right? So if you go to the next slide, you'll see that Canadians have really always been the largest foreign investor in the US. There's good reason for that. I mean, we're so close. We vacation there and things like that. I'm guessing that probably 5 to 10% of our client base owns real estate in the US, okay? And we've always gone there. Wealthy Canadians go there, but you've got to be careful in the US. It's a very different market. I'll give you an example. One of our clients found in the Dallas-Fort Worth area an apartment building that he believed was 60% under market. It was an incredible deal, okay? He tied up the building, and during due diligence, he went out to 6 property managers to submit contracts to manage the property. All 6 came back saying they didn't want to bid on it because there was gangland violence in the property, or gangs were forming in the property. And that's something that, as an outsider, you may not see on the day you tour the property or during your typical sort of Canadian due diligence, right? So I think the importance of having US expertise on the ground is important. And we as SVN have 200 offices in the United States, and we're connected with many more agents than just SVN through the Society of Exchange Counselors, 100 extraordinarily talented real estate people from all over America that when we go to them saying, we've got a Canadian client with $10 million wanting to buy multifamily in Arizona to rehab, they're going to go find us that deal, right? And then you're going to get time that deal will be presented to you. And then you will get time to look at that deal and decide if it's for you. So Canadians already in the US, what we want to do is to give the Canadians who want to go there a path and a methodology to invest in the US because it's so large, right? So let's look at that US market. So when you look at the map of the United States, I mean, this is like, how do you even begin to invest in this marketplace, right? Well, when we introduce you to the experts that we have on our team, they're going to discuss, real simple high level is the difference between red states and blue states. Red states are Republican states, blue states are Democratic states, and typically it doesn't matter what your political leanings are. The red states have population growth, right? And they have less regulation and sometimes lower taxes. So, local people are going to tell you, what area of the province or what area of the state, what county in the state is friendly to business with lower income taxes, where there's growth and things like that. So first thing we're going to do is say, okay, you've got money that you want to invest in the United States into commercial real estate. How do you start zeroing on the geographic footprint of it, right? And then how do you start finding deals? That's what we're going to do. So something you've got to consider, when you're investing in a US state, is a Canadian province, are the legislative issues that you've got to deal with. And I call this the ugly, the good, the bad, and this is the ugly. Government is the ugly. And in Canada, we have rent controls in 6 of the provinces, okay, and we have no rent controls in 4 of the provinces, right? And you've got to consider that when you're making your investment. In the United States, there are different landlord and tenant rules and rent control regimes around the country, and it's complicated. So you have to get local help. So, for example, in Seattle, which is definitely a blue state. You could find this report on the internet, but it talks about really the extraordinary steps that Seattle City Council is taking in the name of tenant protection. And really what they're saying to landlords is that you set your criteria for who will be your tenant, and then you have to accept the first person who comes along. You don't get to choose, right? Well, so you set your rent. Well, now you're going to set your rent high, right? You're not going to negotiate and get someone who might, and so on. So you're just creating a level of bureaucracy and frustration, particularly for smaller landlords. And they're saying that in Seattle, 40% of 1 or 2 or 3 unit owners are actually selling their building just to get out of it because it's become so onerous to become a landlord. That's why, look, there's a lot of great US states that are very, very business friendly and so on, but it doesn't sound like Seattle and investing in apartments is very friendly right now. So getting that local expertise or a local joint venture partner can save you a lot of trouble. So this all leads to sort of what we call the good. What's the opportunity? Well, I think the opportunity is to, for the people who have dry powder and who have money that they want to invest, and believing that we're coming close to the bottom of the cycle, you'll never know if we are or not, but is to get good counseling, okay? And we want to spend time with you, Dave Price, me, the rest of our team, want to talk to you about the buying and the selling opportunities that there are in the United States, right? And I think that it's a conversation that's quite unstructured. It's understanding your history, understanding your family, your children, your tax scenario. And on our last session, on all our sessions, we're probably going to have a CA who's an expert in Canadians investing in the US. There's ways to structure the deal. It's understandable by your accountants, but it's complex if you don't understand it. So we're going to bring the people on to explain to you what are the ways you structure the deal. There's something in the US called 1031 exchanges, where you can sell an asset and then reinvest in that asset again and not pay any taxes. In Canada, you have an apartment building, you sell it, you pay taxes, and then you buy another apartment building. Well, you don't have all the money you have because you had to pay the tax rates that we pay here. So when we have a counsel client, what we want to talk about is, what can you do to make a deal work? What can you add to a deal to make it work? What can you exchange, right? And we're going to show you in the next session that we have at the end of April, some specific deals on how we exchange real estate. Look, if you can just do a straight cash to mortgage or treat as clear, then that's the simplest deal to do. But in a complicated world with things just more challenging, the spread between bid and ask is higher, we need to be more creative to bridge the deal. It's a wonderful opportunity to buy in America. So join us on those sessions and you'll get an email from us. We're pretty busy in the education space. I mean, we always have been, but we've added some, I think, just very, very interesting topics. And our job at Rock Advisors really is to find gaps in the marketplace, okay? And so we do some things that are kind of fun, and we do some free classes, and then we do some paid sessions. Let me just walk through what we're doing. First, we have once a month, we run a longevity session. This has nothing to do with real estate, okay? We just invite people from the real estate fraternity to join us on a Sunday morning at 9 a.m. where we talk about longevity, health, and what we can do to increase our time here on the planet. And I'm really excited. On April 23rd, we have one of the most brilliant Canadian real estate investors, John Love, joining us. John's going to talk about his health journey and what he's done to sort of improve his health. And he's a brilliant man as a real estate investor and tactician. I think it'll be extraordinarily interesting to hear what he has to say about what he's done to improve his personal longevity. The sessions go 1 hour, and there's a little working exercise we all do together, and it's fun. It's fun, and it's about probably the most important thing to you, your health, and we talk about it quite candidly with it. So join us on April 23rd. If you've never come to this session, I think you'd be surprised as to how interesting that it is. April 24th is part 2 of How Canadians Invest in America. We 4 times a year we run high-powered leasing workshops. It's 7 online sessions taught by a university professor, Dr. Vanessa Desal, and on leasing skills. And we run a free session, the first one, for people that just join and get a feeling for what it's like. But it's designed for property managers and your frontline leasing staff into making them great salespeople. We spend a lot of our time on affordable housing, and we've got 3 2-hour sessions coming up, May 24th, 29th, and 30th. If you are a developer, a financier, or at all involved in affordable housing, you want to attend these sessions, and we've got our agenda up, and our speakers are pretty much finalized for that. On June 6th, a topic that we are passionate about and we've done a lot of work with, apartment families. How do you transition from one generation to the next, right? And so how do families think in these uncertain times? Every developer would love to see his building owned by his children, his grandchildren, and then his great-grandchildren. That's sometimes the case. What do you do to set that up? But when that doesn't work, what do you do? And we've done a lot of real estate transactions for families, and we're going to talk very, very specifically about that. I mentioned earlier that we've got to be creative in real estate transactions. On June 28th, we're going to call it the return of the vendor take-back mortgage. Vendor take-back mortgages have always existed in more challenging and difficult times like we're in right now. And we're going to go through the basics of both from a buyer, seller standpoint, and then how you could trade those mortgages. So that's June 20th, and that's a $49 session. And it'll be myself and Daryl McCullough, who's been on a lot of our sessions before, talking about that. In the fall of this year, we're going to bring back on October 11th, Apartment Developer University, our master class on apartment development. We have, Rod, is 10 sessions or 8? 10. There we are, 10 sessions. Yes, we have 10 sessions on how to become an apartment developer. So we assume you have development skills in other asset classes, but you now want to pivot apartments, and it's sort of tied to affordable housing also. There's some great CMHC programs now that allow you to build apartments, I think, finance them much, much easier than you could before. So we've got a full slate of topics that we want to talk to the commercial real estate fraternity about, and we hope you keep joining us on these quarterly events, and then and on these other sessions that we do. Rod, I think that pretty much summarizes everything that we want to talk about. We look forward to seeing you on Thursday, July 6th for our Q2 update. So thanks very much for joining us.